welcome. My name is Brian Caplen, editor of The Banker. I'm here with Philip Alexander, who's the senior editor, and we're discussing the upcoming cover story for the May issue of The Banker, which Philip's written, and it's about shadow banking, Philip. So clearly we've had several years now since the financial crisis of regulating the banks. And I think now what the issue is where has the risk gone to, and how do we deal with that?
That's right, and obviously regulators looked at shadow banking immediately after the crisis, but they looked at very specific activities, things like repo, which is borrowing money using securities as collateral, and obviously they looked at securitization, which was one of the key causes of the crisis. This is the first time where they're really starting to look in much more detail at the sector as a whole, and in particular the entities that are at the heart of what's loosely called shadow banking or market-based finance, which is the asset management industry, essentially.
All right, and in your article, you focus quite a lot on the bond market and the fact that the banks are not playing a big role in providing liquidity in the bond market, which is what they would have done previously. So if we have some kind of liquidity squeeze, actually we can't really count on the banks to help us out next time.
That's right, and this is to some extent an intended consequence of regulation. The bank balance sheets got too large to manage before the crisis. And they didn't hold enough capital, so now they've got to hold more capital, and that means partly reducing the amount of assets that they're holding. But of course that has the effect that in a shock scenario, where the banks before would have been willing to carry on, looking to match up buys and sells and hold some of these assets on their balance sheet for a while until the market had calmed down, they're not really prepared to do that anymore.
All right, so let's sort of talk about two things coming out of that now. I mean, so what are the regulators doing about that? And then I'll ask you in a second about what is the industry doing about that itself. So first of all, let's talk about the regulators, because they are starting to gain an insight into how the whole shadow banking thing is working, aren't they?
Well, they very much, the first thing they want is they want data. They want to know where the risks are. If you think about the banking sector now, the chair of the Basel Committee could probably tell you, which were the least well-capitalized banks or the least liquid banks in the world. They simply don't have that kind of information on asset managers as to who's running the big risks. We know who the big funds are, but some of them may be relatively straightforward and aren't running any risks.
And do you think we'll see some of these non-banks classified as systemically important, as we've seen with the banks?
Well, they've come up with this process to designate them. There is clearly a debate going on, not just with the industry, but even among the regulators. There are some who think that's the wrong approach and they need to keep focused on specific activities. There are some who clearly believe that, in particular, the biggest asset managers or hedge funds that have a lot of leverage should get a designation as a potentially systemic entity.
Okay, now what about the industry itself? Because, I mean, we're starting to see new ways of trading or new ways of kind of trying to find liquidity, aren't they? So what have been the initiatives there?
Yes, and clearly the key is here that if the banks are not holding such a big proportion of the asset managers have carried on growing. The asset managers really need to be able to trade more with each other rather than relying on the banking sector to act as an intermediary. But that's difficult because, of course, their whole thought process is very different. It's about investing for long-term returns, and it's about just looking at a straightforward return on your assets. But the reality is, if they can build and start to really make these platforms work, they can bring down their own cost of execution and potentially reduce their own liquidity risks as well, because they'll have somebody to trade with even if the banks pull out the market.
Okay, fascinating stuff. We'll look forward to reading all about it in the next issue of The Banker.